Back, FoxBusiness.com live. Cotter and Sandra Smith. Jason Van Cleef joins us right now, President and CEO of Van Cleef Financial Group, to talk about the markets. Jason, up 43 points right now, 41 points roughly away from 11,000. The $11,000 question, do we get there today or soon?
You know, it's going to be a fly going to the light. It's going to hit there. But the problem is, and what we've been describing with lots of our clients, is we're at such valuations right now that, you know, in terms of PE ratios, the Shiller Index example gave out that we're above 20. Historically, going back to 1881 when we've seen these valuations, it doesn't bode well for the next decade going forth.
So what are you saying? Are you bearish at these levels?
Yes, we're very bearish. I mean, the best way to think about this is if you had a deli, and let's say the deli cost $10,000, and it earned $5,000 a year, a price of 10, an earnings of 5, that's a P ratio of 2, and of course the lower the number the better. Right now, we have a deli that is earning only $500 a year. So basically, 10,000 divided by 500 is 20. This deli is at a 20 times multiple. The stock market is at equivalent levels.
You say don't be in stocks, and where should we all be if we're not going to buy into the Dow and the S&P?
Well, ultimately, what we've been discussing with clients is these are some of the most opportunistic times, and there's many different investment classes out there. Things like equipment trusts, real estate, oil and gas, bullion, coins. There's different legs on the table that you can put in to basically protect you from whatever economic calamity comes our way.
Now, isn't that also throwing the baby out with the bathwater if you're throwing out good, high-quality names? I mean, won't there be opportunities there to pick and choose certain stocks that might be in sectors that are frowned upon here moving forward?
Absolutely. I mean, oil and gas has definitely underperformed the market over the last year, and now we're seeing oil kind of move up. But of course, that is, you know, directly attributed to things like inflationary pressures that are pushing forward. And, you know, then last week we start having U.S. bond issuances that are being underperforming in a sense. There will be sectors that will perform well, but it's not about throwing baby out with the bathwater. It's about understanding there's other legs on a table to put in to protect.
Yeah, but, you know, I think that a lot of people are probably listening to you right now and saying, yeah, like there's been a lot of bears that have tried to, you know, I guess, put themselves out there and say they're going to sell against this market, but if they have, they've gotten burned. I mean, are you saying that you would be, I don't know if you're putting your money where your mouth is, but are you saying that if you sold right here, the Dow's just going to continue down for years? I mean, if you're a long-term investor, shouldn't you stay in the market?
Well, if you're a long-term investor in June of 1930, when the Dow was 298, and all the headlines told you this was a recovery, you better get in, V-shape versus U-shape, well, what followed next was an 86% correction on the market. So the point is, this is a time to take a breather. We've just experienced one of the greatest rallies in history in the market, and to presume that it's going to go up this equivalent amounts or even just keep trucking forward is unfortunately a little bit foolish in my opinion. And right now, we have a lot of economic headwinds against us for the next year to year and a half. This is a time to take a breather.
Jason, is it hard to look at historical numbers and compare them with what you're seeing right now in the market? You know, you talk about historical Ps and things like that just because we've had such a crazy last 2 years.
Well, we've had a crazy last 10 years. And, you know, ultimately you look at the headlines in history. 1999, they're telling us about the new recovery. In 2006, they're telling us about real estate's unstoppable. And unfortunately, the headlines throughout 2009 and right now are about the recovery has begun. Yet you get certain individuals like Ben Bernanke who not necessarily, you know, they're printing money like crazy. If they really believe the recovery was happening, would they be doing so?
What happens when jobs recover, though? Then the whole world's going to be happy, and, you know, we're going to have tons of optimism in the stock market all over the place.
Well, job numbers are unfortunately a product of the Bureau of Labor Statistics, and they like to change the number around a little bit. A good example, you know, everyone's talking about the census workers. I mean, that's a problem right now. But what the BLS likes to do is add other jobs. For instance, they do something called the birth-death model.
Yeah.
In the month of March, they added 81,000 jobs, phantom jobs, because they make the unsupportable claim that in recessionary times, more companies are hiring people than people going out of business. I look at the business complex my offices are in. There's a lot more businesses leaving than coming. And they say, hey, we're going to add these 81,000 jobs. In February, they added 97,000 jobs. The point is the numbers aren't all what they're cracked out to be.
Jason, we appreciate it.
Thank you very much for having me.
Jason Van Cleef, President and CEO of Van Cleef Financial Group, joining us from L.A., giving us his take. And, boy, very bearish and long-term bearish.